Okay, today we're going to switch gears a little bit and start talking about financial statements. And in particular, today's lesson is Chapter 6, Accounting for Financial Management. Now, previously, we were talking about risk and return in Chapters 2 and 3, and we also looked at a little bit of modern portfolio theory. In the upcoming chapters, 6, 7, 9, and then also 8, we're focused on finding the value of the company. Really, in particular, what we want to know is how much is the equity in the company worth, or in other words, what is the stock worth? So in chapters 6 and 7, we're going to be focused on the financial statements. Now, the problem with this is that financial statements are a record of what has happened in the past, and the value of the firm is based on what is expected to happen in the future. But what we're going to see is that in chapter 9, we're going to talk about forecasting the financial statements. That's going to give us the data that we need so that in chapter 8, we can find the value of the company. In everything that follows from this point on in the semester, it's always important to keep in mind that the goal of the firm is to maximize shareholder wealth. So everything that we do has to take that into account. Remember that the shareholders own the firm. So the firm is operated for their benefit, and maximizing shareholder wealth is the way that we try to accomplish that. So let's talk about the financial statements. This should be a review because you've had 2 previous accounting classes, so you should be familiar with these statements. But let's look at them, and in particular, let's look at them from a finance point of view instead of from an accountant's point of view. So there are 3 basic financial statements. We have the income statement, the balance sheet, and the statement of cash flows. So all 3 of these are important. If I had to pick one that was most useful for financial analysis, it probably would be the statement of cash flows. But as we'll see, everything on the statement of cash flows comes from the income statement and the balance sheet. So all 3 of these more or less work together to give us the information that we need. And ultimately, they're going to provide the clues that we need in order to find the value of the firm. So we'll look at each of these in the slides ahead. So let's start off from the mini case where the setup of the problem is this. So Jenny Cochran, a graduate of the University of Tennessee with 4 years of experience as an equities analyst, was recently brought in as an assistant to the chairman of the board of Computron Industries, a manufacturer of computer components. During the previous year, Computron had doubled its plant capacity, opened new sales offices outside its home territory, and launched an expensive advertising campaign. So in other words, Computron has undergone a major expansion. Cochran was assigned to evaluate the impact of the changes. She began by gathering the financial statements and other data. Note that because Jenny will ultimately use these financial statements in Excel to make projections over time, that will be chapter 9, they are organized with the most recent year at the far right. Now, this is important. If you look at financial statements the way that they're reported, there's 2 ways that the information is organized, either with the most recent year at the left or the most recent year at the right. Most recent year at the left is nice because it places the information that you're probably most interested in right next to the labels. Most recent year at the right is more useful for spreadsheets because then we can take our data and simply copy formulas off to the right. It's just a little bit easier way to do things. So the income statement that they've given us is given here at the right. And the income statement, remember, provides a summary of the firm's revenue, expenses, and profitability over some period of time. And typically that would be either for a quarter or for a whole year. Now, in this case, remember that Computron has just undergone a major expansion. And you can see, if you look at sales, that sales went from about 3.4 million up to about 5.8 million. So sales went up by quite a lot. Expenses went up by quite a lot as well. And if you look down at the bottom line, net income, you can see that net income was positive in 2017, but it's negative in 2018. So this is what management of the company is concerned about. Now, on the income statement, you're going to find 2 different kinds of expenses. We have operating expenses. Now, this word operating is important, and we're going to run into it a lot from here on out. We like to focus on operations, that is the day-to-day things that go on in a business, the normal kinds of things, as opposed to non-operating, because operating is what we do all the time. The non-operating things are by definition somewhat unusual. So our operating expenses here would be cost of goods sold, other expenses, and this could be things like rent for office space, leases on office equipment, the power bill, and all kinds of things like that. These are the normal, everyday kinds of expenses that are involved in running a business. Depreciation is also counted as an operating expense. And remember what depreciation is. When a company buys an asset, they typically are not allowed for tax purposes to expense that cost immediately. Instead, what they try to do is match the expense with the benefit. In other words, they write off the value of the equipment over time, and we call that depreciation. The non-operating expenses are things like the interest expense and taxes. So interest expense and taxes, those are a normal part of everyday business, of course, but they're not really related to the actual operation of the business itself. Interest expense comes from having debt, which is used to finance the business. And of course, taxes are simply the government's cut. Now, in addition to the firm's revenue or sales and their expenses, we also on the income statement have several measures of profits. So we have EBIT, which is earnings before interest and taxes. That's also known as net operating income. We have EBT, which is earnings before tax. And then we have net income, which is sometimes just called profit or net profit or any number of other terms. Now, on the income statement, probably the thing that people are most interested in most of the time is the net income. And as I pointed out here, you can see that last year net income was positive. In the most recent year, net income was negative. And it should go without saying that we prefer positive net income rather than negative net income. And notice, by the way, that they gave us some other data as well. But net income can be a little bit misleading because that's simply the accounting profit. And from a finance point of view, we tend to be more interested in economic profits and cash flow. So the thing to note here is that depreciation is a non-cash expense. So in the history of business, nobody has ever written a check for depreciation. So that money never actually left the firm. Well, it left when they acquired the asset, but it did not leave during the period shown here. It's a non-cash expense, and so we need to add that back to get what we call cash flow. Now, this is the most basic measure of cash flow. We'll talk later about something called free cash flow. That's even more important, but cash flow is simply net income plus any non-cash expenses. And I'll point out that depreciation is not necessarily the only non-cash expense. It kind of depends on the type of business that you're in. For example, if you're involved in some business that extracts natural resources, like the oil and gas business, then you're going to have a depletion charge. And depletion is very similar to depreciation, except that it involves depleting an asset that you have in the ground. There's also amortization, which is for intangible assets. Again, same idea as depreciation, but we call it amortization when it involves intangible assets. So in this case, we can see that cash flow for 2017 was $87,960, that's your net income, plus $18,900, which was the depreciation expense, for a total cash flow of $106,860. Now, it's no surprise that cash flow went down in 2018 because net income was negative. But at the same time, depreciation was much higher. Nonetheless, cash flow fell to $21,824. Now, the balance sheet shows the firm's assets, liabilities, and equity. So the assets are the things that the firm owns. And we usually break the assets down into two categories. We have the short-term or current assets, and we have the long-term or fixed assets. So the current assets are cash, short-term investments, accounts receivable, and inventories. And the fixed assets, well, normally we would see more categories of fixed assets, but in this case we simply have gross fixed assets. Those are carried at cost, and then from that we subtract accumulated depreciation, which gets us to net fixed assets. Now, on the liabilities and equity side, we have, of course, current liabilities, which are the short-term liabilities, accounts payable, notes payable, and accrued expenses, or it's shown here as simply accruals. These are expenses that are owed but have not yet been paid. And then we have our long-term debt, which is typically long-term bank loans or bonds. And then we have equity. And equity is simply total assets minus total liabilities. Equity can be broken down into two different kinds. We have preferred equity, and preferred equity is called preferred because in the event of liquidation of the firm, the creditors would be paid first, then the preferred stockholders, and then finally the common stockholders get whatever's left over, if anything. And usually in the event of liquidation, there's nothing left over. So preferred stock is talked about in textbooks quite a lot, probably far more than it should be, because most companies do not use preferred stock as a method of financing. And in fact, for Computron here, we don't have any preferred stock, but it's important that you be aware that it exists. Preferred stock is primarily used by financial firms, brokerage firms, insurance companies, banks. Non-financial firms tend not to use preferred stock as a method of financing. And then we have common equity, and common equity is typically broken down into three categories. So we have common stock, which is simply the par value of the stock times the number of shares outstanding. We have additional paid-in capital, and where that comes from is, imagine that a company raises money by selling common stock. That common stock will have what's known as a par value. And the par value is simply it's simply a value that's assigned for accounting purposes, and it's typically very low, like 1 penny per share. So common stock is simply par value times the number of shares. But when the stock is sold, it's typically sold for much more than par value, and that the additional proceeds from selling that stock go into additional paid-in capital. And then finally, we have retained earnings, which is simply the accumulated earnings less dividends over time. So those three things add up to what we call common equity. Preferred equity and common equity give us total equity. Now, in this case, you can see the effect of the expansion. If you look at total assets, you can see that total assets pretty much doubled in 2018 compared to 2017. That's because the firm went out and they bought a bunch of assets. And then finally, we have the statement of cash flows. Now, it's important to note that the statement of cash flows contains only information that comes from the income statement and the balance sheet. So there's nothing new here other than the way that it's presented. And it's presented in a way that makes it useful for financial analysis. That's why I said, to me, the statement of cash flows is probably more important than the income statement or the balance sheet. The statement of cash flows is broken up into three sections. The first is cash flows from operations. And again, there's that word operating or operations. And so these are the cash flows that are generated in the normal course of running the business. This is by far the most important section of the statement of cash flows, because at a glance, if we look at the bottom here, net cash provided by operating activities, we can see how well the firm's basic business did during the time frame that's covered by the statement of cash flows. And in this case, cash provided by operations is negative $503,936. Clearly, that is the kind of a situation that is not sustainable in the long run. You cannot have your basic business burning cash like that. This section of the statement of cash flows can be broken up into two parts. We have our basic cash flow measure, which is net income plus depreciation, and you see those at the top. And then we have changes in net working capital. So this would be changes in your current assets and changes in your current liabilities. Now, it's not exactly that. It's close to that. But notice that we do not have the change in cash, and we don't have the change in short-term investments, and we don't have the change in notes payable. So the change in cash is going to be ultimately what this statement shows us. And then short-term investments and notes payable are not operating activities. And so they'll be on here, but in separate sections. The next section is cash flows from investing activities, and primarily what this is changes in gross fixed assets and also the change in short-term investments. And then finally, we have cash flows from financing activities, and this will be changes in notes payable, long-term debt, common stock, additional paid-in capital. Notice that we do not include the change in retained earnings. And the reason for that is that the change in retained earnings is net income minus dividends. We already have net income on here. And if you look under financing activities, you'll see that we have payment of cash dividends as well. So we do not include the change in retained earnings because we would be double counting net income and dividend payments. Now, also notice that some of these numbers are negative and some of them are positive. So negative cash flows are cash outflows. Positive cash flows are cash inflows. And most of the items on the statement of cash flows are changes in balance sheet items. So for example, if you look at the change in accounts receivable, you can see at a glance that during 2018, the company invested $280,960 in accounts receivable. That is, they sold product to their customers and plan on collecting on that later. So that represents a cash outflow because they paid for that product, but they have not yet received a cash inflow from that. Now, at the bottom of the statement of cash flows, we have the net change in the cash for the year, and then we look at the difference. So we have the change in cash is cash from operations plus cash from investing plus cash from financing. That comes to negative $1,718. That's the decline in the cash balance that you saw on the balance sheet. And then it also shows the beginning cash and the ending cash. And of course, the difference there is $1,718. So the statement of cash flows explains what the company did that caused that change in cash. Now, one thing that I noticed that people often have trouble with is getting the sign of the numbers on the statement of cash flow correct. And it's really fairly simple. I've put together a little table here that shows how to always get the correct sign. So let's go through this. If you have an asset, let's say inventory, and it increases, that means the company made an investment, a cash outflow in inventory. So that will be a negative number on the statement of cash flows. On the other hand, if they had an asset that went down, let's say that there was some piece of machinery that the company sold, so gross fixed assets goes down, in that case, that would be a cash inflow, and that would be shown as a positive number. For liabilities and equity, it's exactly the opposite. So imagine long-term debt, for example. If the company raises money by selling bonds, that represents a cash inflow, and it would be a positive number on the statement of cash flows. On the other hand, if they were to buy back common stock, that would be a cash outflow, and that would be a negative number on the statement of cash flows. If you're creating this by hand or in a spreadsheet, very simple rule for getting the right sign always, and that is for assets, we take last year's number minus the most recent number. And for liabilities and equity, we take the most recent number minus last year's number. So if you do that, you'll always have the right sign. Now, there are a couple of items on the statement of cash flow that this table does not talk about. So in particular, we have net income and depreciation expense. Those are the only two items on the statement of cash flows that come from the income statement. And they are not changes in those things. You simply pull them off the most recent income statement. So if they have negative numbers, they're negative. If they have positive numbers, they're positive. Also, dividends paid will always be negative because it's a cash outflow. And as I said, everything else on the statement of cash flows is a change in the balance sheet item, and that table tells you how to get the sign right. Now, back to the mini case. Question A asks, what effect did the expansion have on sales and net income? Well, if you look at the income statement, you can see that sales went up by a lot and net income went down by a lot. But focusing on the dollar amounts makes it difficult to interpret. So for example, did cost of goods sold go up by more than sales or less? Well, looking at the dollar amounts, you have to do some math to figure that out. So it's much better to look at percentage changes. Now, you do have to do some math to get the percentage change, but it makes it a lot clearer what's going on. So in this case, we can see that sales went up by 70%, but the firm's operating costs went up by more than that. So you see that cost of goods sold went up by almost 74%, and their other operating expenses went up by 112%. Depreciation in particular went up by over 500%. So this all looks bad, but it's important to keep in mind that this is simply a short time after the expansion, and very often it takes time for these investments to pay off. The depreciation increase is probably not terribly worrisome because that's simply due to the fact that the firm went out and bought a lot of fixed assets. Now, everything else follows from those big increases in costs. So you notice that EBIT fell by 91%. Earnings before tax went down by 208%. The reason for that is because interest expense went up by a lot. And as we'll see, that's because the firm took on a lot of debt for this expansion. And then net income also went down by 208%. That's troubling. But again, remember that this was a long-term investment, and the 2018 results represent short-term results. And presumably, the company wouldn't have made this investment unless they expected it to pay off eventually. The problem is, because of the dramatic decline in net income, people are starting to second-guess that decision. Now, Part A also asks, what effect did the expansion have on the asset side of the balance sheet? Well, if you look at total assets, you can see that total assets almost doubled. And again, it's important here to look at percentages as opposed to dollar amounts. And so sales went up by 70%, but total assets went up by 96.5%. Now, again, these are assets that the firm can use for many years into the future, and the sales increase and the net income decrease represents only 1 year worth of results. Now, what effect did the expansion have on liabilities and equity? Well, remember the balance sheet must balance. So total liabilities and equity went up by 96.53%, exactly like total assets did. And if we look at the percentage changes, we can start to get an idea of how the firm paid for this expansion. So we see that accounts payable and notes payable went up by a lot, more than doubled, and long-term debt went up by 200%, and common stock didn't change at all. So we can tell then that the firm paid for this expansion by issuing a lot of debt. Retained earnings, which is part of equity, went down, but that went down because of the decline in net income. And then question B says, what do you conclude from the statement of cash flows? Well, if we look at operating activities, we can see the negative net income, the big increase in depreciation. And then we can also tell that accounts receivable and inventories were also major investments that the firm made, and that they partly paid for those, not completely by a long shot, but partly paid for those increases in accounts receivable and inventories with accounts payable and accruals. The fact that they did not pay for the entire increase in accounts receivable and inventories with short-term liabilities tells me that this is a fairly aggressive financing plan. So they're using long-term debt to finance short-term increases in assets. We can also see, if we look at investing activities, that the firm spent $711,950 on fixed assets, and they reduced their short-term investments by $28,600. We already know that they didn't issue any common stock, and we can see that in the financing activities, and also the fact that they paid for this expansion by issuing debt, notes payable and long-term debt. We can also see that the cash provided by operations declined by $503,936. That's a major hit, and this is probably what has triggered management in this case. They're concerned by this major decline in cash provided by operations. This suggests that the underlying business is not very healthy. Now again, don't get too concerned about this because this is short-term results of a long-term investment. Okay, with the financial statements behind us, now we can start to focus on deriving some measures that will be useful for valuing the firm. And the main one of these is what we call free cash flow. Now this is different from the basic measure of cash flow that we talked about before. So free cash flow is the cash that is available for distribution to the investors in the firm after making any required reinvestments back into the firm. So the point here is that the firm generates some cash flow, and then the most important thing that they need to do is maintain the position of the firm. So they have to reinvest back into the firm to keep it growing. Money that's left over after that is available for distribution to the investors. And that's what free cash flow is. So free cash flow can be used for several things. It can be used to pay interest expense. It can be used to pay principal on debt. It can be used to pay dividends, pay for stock buybacks. Or if they've done all of that and they still have money left over, it can be invested in non-operating assets, which means what they would do is temporarily park it in some kind of short-term investments. So they might go out and buy some treasury bills or a money market mutual fund or something like that until that cash is needed in the future. Now, it's important to note that the value of an investment, stock or bond or whatever, is the present value of the expected future cash flows. And because of this, the value of the company is the present value of the expected future free cash flows. Remember, free cash flows belong to the investors in the firm. Therefore, the value of the firm to those investors is the present value of the future free cash flows. So free cash flow is very important when it comes to valuing the firm. And we'll see that in particular in chapters 8 and 9. So let's talk about calculating free cash flow. Now, the basic formula here looks pretty simple, but I'll warn you in advance that there's going to be a lot of abbreviations of things that you're going to need to memorize. So free cash flow is simply NOPAT, which stands for net operating profit after tax, minus the change in total operating capital. There's that word operating again, very important. So let's break this down. So NOPAT, again, that's net operating profit after tax, is simply net operating income, or EBIT, times 1 minus the tax rate. So this is what net income would be if the firm had no debt. Total operating capital is your net operating working capital, or NOWC, plus the net operating fixed assets. Net operating working capital is your operating current assets minus operating current liabilities. So remember again that this word operating means the things that are used in the business on a day-to-day basis. So operating refers to assets and liabilities that are used in the ordinary course of doing business. And the distinction between operating and non-operating assets or liabilities really is whether interest is paid or earned on them. If interest is paid or earned, they are not operating. All right, now part D in the mini case asks, what is Computron's NOPAT? So remember that NOPAT is simply EBIT times 1 minus the tax rate. And this is what net income would be if they had no interest expense because they had no debt. So NOPAT is what net income would be for an all-equity financed firm. And if you go back and you look at the income statement, you'll see that EBIT in 2017 was $209,100, and they told us that the tax rate was 40%, so that gives us NOPAT of $125,460. The same calculation for 2018 gives us NOPAT of $10,464. So NOPAT fell by quite a lot in 2018 compared to 2017. Now, the question also asks, what are operating current assets? Well, operating current assets are going to be cash, accounts receivable, inventories, and there may be some other current assets as well, but it does not include short-term investments. Why not? Because short-term investments earn interest. Remember, by definition, short-term investments represent money that has been set aside from the business because it's not currently needed. So short-term investments are not operating assets. What are operating current liabilities? Well, operating current liabilities, again, are those that do not involve paying interest. So we usually have accounts payable, maybe some accrued expenses, and possibly some other current liabilities, but not short-term notes payable. So let's calculate operating current assets for 2017. If you look at the balance sheet, you'll see that cash was $9,000, accounts receivable $351,200, and inventories was $715,200. So our total operating current assets for 2017 were $1,075,400. In 2018, operating current assets went up by quite a lot, almost double. That's a part of the expansion. Remember, they increased their accounts receivable and inventories by quite a lot. Operating current liabilities in 2017 were accounts payable and accrued expenses. So $145,600 plus $136,000 gives us $281,600. In 2018, that went up again by quite a lot to $608,960. So partly the increase in operating current assets was paid for by an increase in operating current liabilities, but not entirely. So the increase in operating current liabilities was, a little over $200,000, but the increase in operating current assets was $900,000. Now, what we're going to need to know for free cash flow purposes is what is net operating working capital, and that's simply your operating current assets minus operating current liabilities. So in 2017, operating current assets, as we calculated, is $1,075,400, and operating current liabilities was $281,600. So the net operating working capital in 2017 was $793,800. In 2018, net operating working capital went up to $1,317,842. Total operating capital is simply net operating working capital plus your net operating fixed assets. Now notice that I'm presenting this as net operating fixed assets, and I'm not including depreciation because the accumulated depreciation is already accounted for in the net fixed assets. So it's included here implicitly. So let's do this calculation. In 2017, we calculated just a minute ago that net operating working capital was $793,800, and our net operating fixed assets from the balance sheet was $344,800. Now, let me point out one important thing. Many businesses will have some non-operating fixed assets. For example, you might have, let's say, a home builder, and if that home builder owns a bunch of land that they're not currently building on, we would classify that land as a non-operating fixed asset. So that would not be included here. In the case of Computron, all of their fixed assets are operating. Remember, we didn't have a breakdown. All we had was gross fixed assets, accumulated depreciation, and net fixed assets. So there's no way to distinguish between operating and non-operating fixed assets. So we're simply using the full amount here. In 2018, we have total operating capital of $2,257,632, which is pretty close to double what it was in 2017. So to calculate free cash flow, what we need, remember the formula is NOPAT minus the change in total operating capital. So we need to know how much was invested in total operating capital in 2018. And that's simply $2,257,632 minus $1,138,600 for a total investment of $1,119,032. So at this point, we've calculated everything that goes into the calculation of free cash flow. So we know NOPAT in 2018 was $10,464, and we know that the change in total operating capital was $1,119,032. So we can calculate free cash flow as the difference between those, NOPAT minus the change in total operating capital, and that gives us negative $1,108,568. So clearly, negative free cash flow is not a good thing. Remember that free cash flow can be used to pay interest, pay off debt, pay dividends, buy back stock, or invest in non-operating short-term assets. And you can't very well keep that up over a long period of time if you're generating negative free cash flow. So let's see what they used this free cash flow for. They paid interest, they issued some debt, they paid some dividends, they did not buy back any stock, and then they reduced their non-operating assets, that was the short-term investments, by $28,600. So that's what they did with this negative free cash flow. If you add those things up, you'll get negative $1,108,568. Now, we're trying to figure out if the firm is creating value for their investors or not. So free cash flow is one way to look at that, and we've seen that free cash flow was negative, which suggests that at least in 2018, they destroyed some value. We're going to look at a couple of additional ways of evaluating that. And the first is called return on invested capital. Now, hopefully you remember from Finance 3300 this concept of return on assets. That is net income divided by total assets. Well, return on invested capital is the same concept, except it focuses on operations, not the totals. So return on invested capital is going to be NOPAT, that's your after-tax operating earnings, divided by total operating capital. So it's the same idea as return on assets, but it focuses on operations, which I've already argued is more important. This is going to give us a percentage, and we need to compare it to something to know if it's good or bad. And that thing that we compare it to is the weighted average cost of capital. And the weighted average cost of capital is the required rate of return of the firm's investors. And so if the return on invested capital exceeds the weighted average cost of capital, that tells us that the firm is earning more than the investors require. That's good. If the return on invested capital is lower than the cost of capital, that tells us that the firm is not earning its required return, and that's bad. So part F of the mini case asks, calculate Computron's return on invested capital. Computron has a 10% weighted average cost of capital. And what caused the decline in the return on invested capital? Was it due to operating profitability or capacity utilization? Do you think Computron's growth added value? So in 2017, we had NOPAT, which we calculated earlier, of $125,460, and total operating capital, also calculated earlier, of $1,138,600. So we have a return on invested capital of 11.02%. Well, their cost of capital is only 10%. So that means that the firm earned more than was required in 2017. So they were creating value. In 2018, the return on invested capital was 0.46%. That's far less than the 10% cost of capital. So we know that in 2018, the firm was destroying value. Now, this was primarily due to a reduction in operating profitability. So notice that NOPAT went from $125,000 down to about $10,000. That's the major cause. Also, obviously, they increased their total operating capital by quite a lot. Now, again, this is only 1 year's result, and so hopefully in future years, Computron will come back and start generating more than their cost of capital again. The important lesson to take note of here, remember that Computron increased their sales by 70%. But growth in sales doesn't matter unless that sales growth is profitable. That's the key that you have to understand here. Growth simply for the sake of growth is not a good idea. It has to be profitable growth. Now, another measure that we can use to evaluate the firm is called economic value added. So we talked earlier about net income, or what I like to call accounting profit, and that really is not sufficient to determine whether or not the firm is creating value for investors. And there's at least two reasons for this. Number one, non-cash expenses are subtracted in calculating accounting profit. Remember, we deducted an expense for depreciation. Secondly, accounting profit accounts for the interest cost, that is the cost of debt, but it completely ignores the cost of equity. So if you start a business, it's great to be able to pay your interest expense, but you also have to be able to pay yourself. In other words, you have to cover the cost of equity as well as the cost of debt. And net income or accounting profit ignores that completely. It's better to focus on a measure of profitability called economic profit, because that accounts for all of the costs, even the opportunity cost, that is the cost of equity. EVA, economic value added, is a measure of economic profit. Now, this was created in the 1980s by a consulting firm called Stern Stewart and Company. What they did is they kind of dredged up this concept of economic profit from about 100 years earlier and kind of dressed it up, trademarked it, and all of that. And for a while, EVA was used by all of the big firms because it was supposed to better correlate to the changes in the stock price. Now, a lot of research was done, and it was found that EVA kind of worked and kind of didn't. It mixed results, but the concept is sound. And so we'll take a quick look at EVA. Now, the calculation can be very complicated because the financial statements of big businesses are complicated, and there's all kinds of adjustments that have to be made and so on. But for our purposes, we can simplify this quite a bit. So EVA is simply net operating profit after tax minus the cost of capital in dollar terms. So notice that second term is the weighted average cost of capital times total operating capital. What we want to do here is we want to compare after-tax profits to the cost of capital. Well, we can't take a dollar amount minus a percentage, which the weighted average cost of capital is. So we have to convert that into a dollar amount by multiplying the cost of capital by the amount of operating capital. So the idea here is how much did you earn, that's NOPAT, minus how much did it cost you to employ the capital that you did. Whatever's left over is called economic value added. So in part G, they say Cochrane has also asked you to estimate Computron's EVA. She estimates that the after-tax cost of capital was 10% in both years. Now, we've already calculated NOPAT for both years and operating capital for both years, so the calculation here is going to be pretty straightforward. So for 2017, we have NOPAT, $125,460, minus the cost of capital, 10%, times total operating capital, which was $1,138,600. So we have economic value added in 2017 of $11,600. Now that may not sound like much, but remember that EVA would be zero if the firm earned exactly its required return, its weighted average cost of capital. So this extra $11,600 goes to the shareholders, and they're going to be pleased with that because they're getting more than their required return. So this is good. As long as EVA is greater than zero, everything is good. Now, in 2018, we have NOPAT of $10,464, and operating capital, remember, went up by quite a lot to $2,257,632. So EVA in 2018 was negative $215,299. Again, we see that the firm destroyed value in 2018. Note that this is the same conclusion that we drew from the return on invested capital and even from looking at free cash flow. This is not a coincidence. Remember, EVA is NOPAT minus the cost of capital times total operating capital. So essentially, we're comparing NOPAT and total operating capital. And return on invested capital is the same basic idea. So in both cases, we have NOPAT and total operating capital. So it's no coincidence that we drew the same conclusion. Now, finally, a much less important measure of value creation is something called market value added. It's not that this is less important. I just find it to be less useful than free cash flow, return on invested capital, or EVA. So MVA is simply the change in the value of the firm over what was invested by the shareholders. So MVA is simply the market value of equity minus the book value of equity. Now remember, the market value of equity reflects what shareholders believe the future cash flows are going to be, and the book value of equity represents what shareholders have invested in the firm. So MVA measures the value creation over and above what has been invested in the firm. So it's a good idea. I just find it to be less practical. So the market value of the equity is simply the stock price times the number of shares. And they told us that the stock price in 2017 was $8.50 a share and that there were 100,000 shares outstanding. From the balance sheet, we can see that the total common equity was 663,768. So that tells us as of 2017, there had been $186,232 in value creation. By 2018, this had fallen to 42,368, and that's for two reasons. Number one, the stock price went down. And number two, net income was negative, and so retained earnings went down. And so I think if you're going to look at market value added, the important thing to look at is the difference between what it was in the previous year and what it was in the most recent year. And you can do the same thing basically by just looking at what happened to the stock price. And that's why I don't think market value added is all that useful. Just look at what happened to the stock price, and that'll tell you most of what you need to know. All right, now a couple of other things that we want to talk about here, which are related to taxes. So let's look at how to calculate corporate taxes. Now, before we get into this, note that the Tax Cut and Jobs Act of 2017 greatly simplified the calculation of corporate taxes and lowered the rate to a flat rate of 21%. Previously, we had a progressive tax system where the more you earn, the higher the rate you pay is. So by lowering the tax rate to 21% from about 35% for big firms, the government made investment much more profitable and therefore more likely to occur. They also simplified things quite a bit by making it a flat rate. But we're going to look at how it was calculated earlier because we'll probably go back to a system like this at some point in the future. So you can see the tax table here, and this is prior to the Tax Cuts and Jobs Act of 2017. And the way that a progressive system works is on the first chunk of income you pay one rate. On the next chunk of income you pay a little bit higher rate. On the next chunk you pay a higher rate, and so on. And so you can see that the first $50,000 was taxed at 15%. The next $25,000 was taxed at 25%. The next $25,000 at 34%, and so on. Now, in Part I, in the mini case, they say, assume that a corporation has $100,000 of taxable income from operations, plus $5,000 of interest income, that's non-operating income, and $10,000 of dividend income. What is the federal tax liability? Well, the operating income is fully taxable, so that $100,000 is fully taxable. The interest income is also fully taxable, but the dividend income is not. And to understand why some of that dividend income is not taxable, think about it this way. Imagine that we have firm B that owns shares in firm A. Firm A pays a dividend to firm B. Now note that firm A first paid taxes on their income, and then out of that after-tax income, they paid a dividend to firm B. So right there, the income has already been taxed once. Now firm B then pays taxes, so that's twice, and then they pay a dividend to their shareholders who again pay taxes. So that same income has been taxed 3 times, and that seems unfair. And so what Congress has done, or had done up until the 2017 Act, was to allow for corporations to pay taxes only on 30% of their dividend income. So of that $10,000, only $3,000 is taxable. And so that gives us total taxable income of $108,000. Now, if we go to the tax table, we see the $108,000 falls into that range of $100,000 to $335,000. So that means they're going to pay $22,250 on the first $100,000 and then 39% on everything over that up to $335,000. So they're going to pay $22,250 plus 39% of the additional $8,000, and that gives us a tax liability of $25,370. Now, again, today this tax liability would be lower, and it would be lower for 2 reasons. One, there's a flat 21% tax rate. And secondly, the dividend exclusion has gone down from 70% to, I believe, 50%. So the tax today would be a little bit different, but lower than it was previously. Now, finally, in Part J, the mini case says, assume that you're in the 25% marginal tax bracket and that you have $5,000 to invest. You've narrowed your investment choices down to California bonds with a yield of 7%, or equally risky ExxonMobil bonds with a yield of 10%. It's important to understand that those California bonds are exempt from federal taxes, or more specifically, the interest earned on those California bonds are exempt from federal taxes. So that 7% is effectively an after-tax yield. But the interest on the ExxonMobil bonds is fully taxable. So that 10% is a pre-tax yield. We cannot compare after-tax yields directly to pre-tax yields. We have to adjust for this. So the after-tax return on those ExxonMobil bonds would be the before-tax return times 1 minus the tax rate. And remember, the tax rate here is 25%. So what we have is 7% after-tax return for the California bonds and a 7.5% after-tax return on the ExxonMobil bonds. So which would you rather own? Well, assuming you're rational, you would rather own the Exxon bonds because you have more money after tax than you would have from the California bonds. But note, the higher the tax rate, the more attractive those California bonds would be. So if you're in, say, a 40% tax bracket, in that case, you would rather own the California bonds. Now, it also asks, what would the break-even tax rate be? In other words, at what tax rate would you be indifferent? And all we have to do is solve that equation for the tax rate that equates the 10% before tax to the 7% after tax. And so here's the equation. And then if we solve for the tax rate, you can see that the tax rate would be 30%. Okay, so I hope that you found that useful. I'll take a very quick look at the spreadsheet for the mini case. We've already been through pretty much the entire mini case. So I'll just take a very quick look at that, and then we'll be done for this chapter. The next time, we'll look at chapter 7. Okay, so this is the spreadsheet that I have for the mini case in chapter 6. And this first worksheet here is kind of the doing all of the calculations. So you can see that we have net operating working capital, total operating capital, NOPAT, free cash flow, return on invested capital, weighted average cost of capital, economic value added, market value added, and so on. I also have the tax calculation and the tax table in here, and then that little bit about after-tax yields that was right at the end. The other thing to be aware of is that I have different worksheets in here that have the data that was given to us. So here is, for example, the income statement that was given, and I've calculated the percentage changes in all of those items. Here is the balance sheet, same thing with the percentage changes. Down at the bottom here, I have some preliminary calculations: net operating working capital, operating current assets, operating current liabilities, etc. And then we have the statement of cash flows. Now, in the statement of cash flows, you might pay attention to this. You notice that I've done all of the calculations. So unlike what they gave you in the book, you can see exactly where the numbers come from. And again, here is the very first worksheet. And as I said, we've been through all of these calculations, and so I don't see any need to go through the worksheet. But I encourage you to not only work the mini case out, but to also take a look at this spreadsheet. All right, I hope that you found that useful. Next time we'll do chapter 7.